Welcome to the next episode of Basics of Institutional Trading. In our last video, we have discussed how we can detect footprint of the institutional activities in a single candlestick. We will continue our understanding of those institutional footprints as we can find them everywhere on the charts. Once you understand the institutional trading psychology or their style, you will easily detect them. In today's video, we will discuss the building block of the market structure, which are the swing high, swing lows, and the trend. We will try to understand how you can actually look the institutional footprints in an impulsive move and in a corrective move. This video is going to be into the two parts. The reason why, because the video is, I don't want to keep the video more than 15 to 20 minutes. So if we will break somewhere, then we will continue in the next video. We will start with the very basics and progress more complex as we advance in our course. So without further delay, let's start with this regulatory disclaimer and some housekeeping. The video is presented only for educational purpose, and it is not a recommendation or buy or the sell at all. No, this is a financial advice. Okay, so with the regulatory gone out of the way, and now let's some housekeeping. If you like our videos and you think our way of the trading is beneficial to you, you can join our free Discord server, where we regularly review the Australian Stock Exchange, Pakistani Stock Exchange, US stocks, National Stock Exchange, India, Forex, cryptos, and the commodities. We normally try to update our Discord server with at least 2 or 3 trades of each of the market every week. You can also follow us in our various social media handles. In the YouTube, you can subscribe to our YouTube channel, K5 Trading, for the regular updates and the timely reminder of our videos. You can join us on the Facebook page, K5 Trading. And you can join us on the Telegram, which is our K5 Trading. After those social media handling, let's move to the course. So last course was the single candlestick, and we were going to look at how the you can find out the institutional footprint in the single candlestick. In this module, which is the market structure, we will try to understand the very, very basic concept of the market structure and how we can read those market structure from institutional eyes. So building block of the market structure. Pivot points are the highest and the lowest priced of a bar pattern. And this bar pattern normally consists of the 5 bar, where each bar actually high and lows make a higher high and the lower highs. But I consider a pivot point only 3 candles. So this is the high, higher high, and the lower high. For me, this is the pivot high. And the same thing, this is a low, lower low, and the higher low, this is a pivot low for me. I consider this a swing high, and I consider this is a swing low. I don't actually follow those 5 pattern of fractal point, which developed by Bill Williams and used everywhere. I only consider those the top 3 ones. So high, higher high, lower high. For me, this is the confirmation market wanna move or change the direction, and the same thing, low, lower lows, and higher lows. I'm understanding market wanna move the direction. Pivot points are created when the prices bounce or reject the new high or the lows. They help to identify higher high and the higher lows, which is a basic, very, very basic concept of the trend direction or understanding the trend direction. Okay, another name of this one, as you know, the fractal or the swing point, they are the fractal in the market. So you will find on the daily time frame, on the 4-hour, everywhere you will find them. Even the one swing high on the weekly time frame or the daily time frame, like this one, high, higher high, lower high, that will be a complete change of the direction on the lower time frame. So that's very, very important. Okay. A reversal in the market cannot happen without a creation of those pivot points, but not all pivot point will lead to the market reversal or the retracement. When I say retracement and the reversal, until I can distinguish between them, they are the phenomena. So for example, a retracement on the weekly time frame is a reversal on the 4-hour, of the internal trend structure, which is we will understand as we move along in our course. Now, let's start with the bull trend and the bear trend and how they actually go. The bull trend is make of the market move up and down. So this is your low and this is your high. First thing you need to understand, market never ever move into the one direction. It always needs to the pullback. If there is no pullback or if there is no retracement, then nobody is willing to sell into the market, and the market and there will be no seller, then there will be no one can buy it. So market will stagnate. So that's why a pullback or a retracement is very, very important for market to perform well in the balanced way. Now, normally, before I can go to the bull and bear trend and the consolidation, I like to introduce you to the two move in the market. This is your impulsive move, and this is your corrective move. The impulsive move of the market is always in the direction of the trend where the market want to go. If the market is bullish, then your impulsive move will be facing towards north, and if you're bearish trend, then the impulsive move facing to the south. Okay, now this entire leg, this entire impulsive leg, again, remember how we actually divided a candlestick into the two parts, 50% above and 50%. So like just we simply did the 50%, the above, the premium and the discount. We will do the same here as well. So this is our discounted zone, and this is our premium zone, right? Now, what's exactly happened now? We want to understand how actually the institutions actively doing, or what the institutions doing in each of those areas. So institutions are quietly accumulating or buying an asset or a stock or a symbol around here, where in the discounted zones. Once they've done their accumulations, when they achieve the target of the accumulating enough stocks or assets, they will start moving the prices up. When the prices move upside, above the 50%, the people or the retail traders, they start to detect, and they will rush to buy somewhere around here into the premium zone. That's the human psychology. That's market. They want to chase the market. When they are buying here, who is selling? That's very, very important to understand. The people who bought here, now they are selling here. And who are buying here? Here, the retail traders, they are buying here. When the retail traders are buying here, the institutions are selling here. So they are actually taking a profit. But because they want market to continue into the upside move, and they also want to accumulate now, but they never ever accumulate into the premium zone. So what they will do, they will start pushing the prices down into the discounted zone. When the market come into the discounted zone, and the pullback or the retracement is 100% the activity of the institutions. You and I, a retail trader, cannot actually do this activity. This is their activity. This is their way. And that's how they actually move the market down. Their intentions are three. Their first intention is that they want to accumulate more. They want to buy more. That's why they want to bring down into the discounted area. And they will start buying around on this area, right? When they're bringing down the prices right up here, so they got their positions exposed in the premium area, right? They are selling, okay? They are selling here, and they are shorting the market. So they got an exposed position in this area, and sooner or later, they want to close this one. Now, the people, when they see the market is tanking downwards towards the south, those retail traders, they start selling here. Panic selling. With this panic selling, who is buying? The institutions are buying here. So this was their initial intention to buy of this particular stock because they are going to move the prices higher. So now they start moving the prices higher. And because they were doing some short selling here, so those short selling, they are starting to cover in this the discounted zone. So they're making the money from here, and they're making the money buying the stocks which sold by the retail trader in the panic mode, and now they move the prices higher. Okay, so these three move, this move what created up here, this impulsive and the corrective mode, that is the entirely institutional activity. On this impulsive mode, the below the 50%, institutions buys, and in the premium zone, the institution sells. The retail traders buys here, and they actually panic selling in below the 50%. So this is the psychology of the institutions you need to understand in this impulsive move and the corrective move. Now, with the bull trend, it's you got an impulsive move, you got a corrective move, you got an impulsive move, you got a corrective move, you got an impulsive move, you got a corrective move. Every time market actually break the previous swing highs with the body close, body not the wick, this is the body. So with the body close, even if it's break it, that's we call the break of the structure, and the break of the structure actually confirm that the trend is in one direction. This will continue until we actually stop seeing the break of the structure in the direction of the trend, and we start seeing it the opposite direction. So that's your break of the structure, which is this area, and this is your confirmation of the trend, right? So these two things we already cover with the understanding of the bullish trend. Now you see that's you have seen those bullish trends like higher high, higher lows, higher high, higher low. That's fine, that's all right, no problem. Everybody understand this one. Here we are trying to understand what exactly the institutions are doing in each of those legs. So I'm repeating again, this leg up here, the corrective mode, that's the institutional activity, solely institutional activity, and this is the institutions actually buys on the 50% and the sell in the premium zone. Now let's have a look into the chart. I have write those rules in my chart here. Right, so you can see in this chart, I have write that's this impulsive move and this corrective move. And here I said the buying in the discounted zone, selling in the premium zone, right? This is the move when the market is moving upside or the bullish trend. Corrective pullback or move, selling in the premium zone of the pullback and buying in the discounted zone of the pullback. So just keep this one aside and let's start to understand or try to identify those trends. So I'll go to the weekly time frame because this is where I found a nice move upside. Okay. Right. So here we got low. Maybe we can start with this. Hang on. Sorry. So the market is coming down. It's gone up. Okay, the gone up because the break of the structure is here, is not here. As I said, the break of the structure has to be with the body, not the wick. So from this wick, right up here is the break of the structure. So let me mark the break of the structure. So from this wick high, right up here is the break of the structure. So that's my first impulsive leg after the change of the character. And after that impulsive leg, market is pulling down, and then it's move up again. Now the second time the break of the structure is from here to here, so that's move upside, right? Now if you look at this area, break of the structure. Okay, so until we can see the market actually stop making break of the structure into the upper side, we will continue, we will assume that the market is in an uptrend. For example, the market is start making a low from here, high, right? And this high didn't break the previous structure, right? And then it's moved down, and we can see that the structure is now breaking up other way around. So we can consider this is a change of the character. Now let's try to understand the bullish in this move, the institutional footprint, how we can identify them. So in the impulsive move, when you see those big candles, these big candles are the activities of the institution. They are actually pushing the prices upside. This is the accumulation up here in this area. And then they break it here and then market move upside. They bring it down slightly and then they move up and this down and they move up. So these are the activities of the institutional footprints with the wide range of the bodies and the low wicks. When you start looking at the high wicks at anywhere, you can try to understand that this is the area where the price is quite efficient and the retail traders, they are enter into the market, or there are some buyers and selling pressure equal in this area. When the pullback, you look at the pullback. In the pullback, you can easily see there's lots of price efficiency. And those big candles which are bringing the prices down by institution, this is the reason why they're doing this one. They want to have the people to panic selling, and then they want to buy up here, right? And the same thing on this area up here. And then again, you can see the impulsive move. You can start looking at the big candles. So these are the footprints you can identify in any market or in anywhere with the institution into the impulsive move and the corrective move. Okay, the next what we got, the internal structure of the current time frame and the external structure of the higher time frame. I will just simply cover the external and the internal structure of the current time frame. The internal structure of the higher time frame and the lower time frame I will cover next time because we don't have we are short of the time here. So we need to break up this the market structure in the 2 videos. So let's just try to cover the internal structure. When you see this impulsive move from this point to this point, this is our external structure. Any activity is happening inside of this one until it can break the previous low or the previous high. This is considered the internal structure. The internal structure always gives you a hint when the market completes its pullback. This can happen in the lower time frame and this can happen in the current time frame as well. So I will stop my video right up here with the external structure. And in the next video, we will elaborate a little bit more on the external structure and the internal structure. And we will try to cover a basic strategy, which call 1, 2, 3 reversal strategy. And we will also try to cover in our next video is what's the difference between the reversal and the retracement and how we can identify them. Until then, happy trading and goodbye for now.